Welcome to the January 2023 monthly MOTR checkup. My name is Dave Lundgren, and I'm the Chief Market Strategist here at MOTR Capital Management and Research. We have a lot to cover this month, as there's a lot actually taking place as the new year begins. So let's just hop right in. It's our view that in time we will look back at the October low as being yet another bear market that was sent to hibernate in October. October is the most common month for a bear market bottom, and I think the way I try to think about markets is that the market can do one of three things at any given time. It can go up, down, or sideways, and I believe that at any given moment there's enough evidence on the table to eliminate one of those scenarios. And for all of 2022, the scenario that was that we could eliminate based on the evidence we had was sustainably higher or just up. That left us with sideways to down to position for the balance of 2022. And that view was largely driven by our risk gauge, which calculates the overall technical condition across 4 different timeframes, which we'll talk about in a moment. But I think there's enough evidence mounting today to suggest that we can now instead eliminate down, which means that bottom that we hit in October was it. And from here on out, we can look forward to sideways to higher. And if that's the case, then the market itself is no longer a headwind to stock selection. So whether the market goes up or sideways, frankly, we'll take either. We prefer up, but for now, at least the evidence supports no longer down. So we can now focus more on stock selection and likely have much less involvement on the short side. So what I see today is there's basically two things that we need to wrestle with. One is setup and the other is signal. So setup is basically the precursors to an expected condition. And when you think about what do bear market bottoms typically look like, how are they typically set up? I think we've had that all throughout 2022 through various stages of the year. And of course, culminating as the year finished up with the implosion of the FTX exchange and crypto assets in general. But it starts with the market itself being down 27%. That's a pretty good setup for a bull market. I mean, if you look back to 1940, half the time the market's gone down this much, it's either stopped and turned higher again. In other words, resumed the preceding bull market, or it continued lower. So at least we can say half the time when you have this as a setup, the market is near a bottom. And then other things that kind of contributed to this 27% decline is the narrative. And the narrative became well accepted as the year wore on, with runaway inflation, a shift in the monetary the monetary policy of the U.S. Central Bank, war in Europe, tensions in China, risk of recession, finally getting some layoffs, particularly in tech. And as I mentioned, the implosion of the FTX and the crypto asset space. And of course, a very good indication that the bear market has sort of run its course is the former leaders from the prior bull market are down 80 to 90%. That's also a very common aspect or element of a cyclical bottom. And of course, as we've been talking about all last year, sentiment has been the most bearish on the market as it's been in either a long time or ever. We're talking about records, bearish sentiment. And then, of course, we can also look to the calendar and identify that 2022 was a window where we should have expectations of a cycle low, either because of the 4-year cycle low, 2022, or the presidential cycle. And of course, coming into October, as I said earlier, October is a very common month for the market to bottom. So that's the setup. And as we know, a lot of these things existed for much of the year, with fears of recession and a lot of these stocks being down 80 to 90%. Record sentiment, bearish sentiment was sort of a underpinning to the environment all year last year, and yet the market continued lower anyway. So that's the distinction between setup and signal. So setup is sort of like buying a setup without a signal or without a catalyst is like buying a value stock just because it's cheap, and instead not waiting for the fundamental catalyst that's required to unlock that value situation. And as we all know, a value stock without a fundamental catalyst is a value trap. And so I would say that much of last year was essentially a setup trap for technicals, in the sense that we had all these reasons to expect a low, but we never did get one, just because the market just did not provide that catalyst. There was no technical underpinnings that indicated that the market cared about any of this stuff until this year. So as we roll the calendar into 2023, we've actually finally gotten the first uptick in our longer term risk gauges since this bear market started. So the way we think about it is, this is the setup, and when you have these ingredients for a potential major low, when you get the indication from the market that it actually cares about this stuff now, then you have the ingredients for what could be a pretty powerful cyclical bull market. And so we think that that's the case. We think that we now have enough evidence vis-a-vis the 4 time frames of risk gauges all coming together, and I'll explain that in a moment. But we now have enough evidence in our mind to support the idea that we can eliminate down from here. So that means that we're bottoming, in our view. And just remember that bottoms are frustrating. They're a process. They can be very frustrating. They're still very emotionally charged, because it's a lot of short covering and it's a lot of timid buying, because you're not quite sure, which is the mirror image of the type of buying you see at the peak, which is very confident buying. And of course, that never pans out either. So right now, buying is very timid. It's very at the margin. And so as a consequence of that, there still can be a lot of volatility. And I would anticipate that we'll see volatility in that 41 to 4,300 resistance area, which we've been outlining for about a month now. And while we're wrestling with that 41 to 4,300 area, we should expect to see volatility there, maybe even some setbacks from there. The key thing is that we don't want to see 38 to 3,900 taken out on support. We identified that level last month in last month's video. And it turns out that the market rolled over in the beginning of December, went down and tested that area several times at the bottom of 3,800, and it held. That's important to begin with. But then on the rally that followed that test, that's what drove the longer term risk gauges higher, sort of fortifying that 38 to 3,900 area as support. So we really want to see that area hold up into any weakness that we might get as a consequence of just sort of testing and working our way through this 41 to 4,300 area. So with this change in our view from sideways to down expectations to more sideways to up, obviously that's going to have changes and consequences to the portfolio. So we'll discuss how we're changing our portfolio positioning as well. So let's start with the obvious, and that is that the index itself is still in a downtrend. Here's the 41 to 4,300 resistance area that I mentioned, and here is the 38 to 3,900 support area. And you can see how it got tested pretty well towards the end of December, and it's thus far held up. So just looking at the index itself, just any trend following investor could look at this and see clearly that it's still in a downtrend. So obviously this isn't helpful. We know that this is the case. What we're looking for are indications of trend change beneath the surface that indicate that the winds of change are blowing in basically setting the stage for the index itself to change course and begin a new trend to the upside. Much like as strong as this bull market looked in 2021, this risk gauge work began to deteriorate in the middle latter part of 2021, warning that a bear market was forthcoming. Much like how we saw that happen in 2021, I believe what we're seeing now is, as bad as this index looks and as much as it's in a downtrend, as you can see, the fact that these risk gauges are starting to turn, indicating that there's structural change taking place in meaningful timeframes. Again, this is monthly and quarterly charts driven by fundamentals. So the market knows all these setups. It knew it all year last year. It knew all the conditions that prevailed in the market, and it ignored all of it last year. But now it's starting to uptick, indicating that it's already discounted all that. And now as the market does, it's starting to look forward. And as it looks forward, one stock at a time will begin to reflect that change in market opinion, if you will. And one stock at a time, it will begin to change the trend of the overall market. And that one stock at a time analysis is what exactly the risk gauge is intended to detect as it's unfolding. But just remember that the risk gauge is not some artificial intelligence, machine learning, super quant model. It's purposefully not that, because in my career I've seen so many of those efforts blow up. This model is based on the first the I guess the checklist of trend change is what I referred to it in the past, or the inviolable rules of trend following, or first principles of trend. These are things that must happen in order for the trend to improve. So each of these 4 timeframes of the trend of the risk gauge, they all contain elements of absolute trend, relative trend, momentum, breadth, and volatility. These are the things that must change in order for the market to change. And so if it's not one of these 5 characters of trend, then it's not in this model. So there's no valuation, there's no sentiment, there's no calendar, cycle lows or anything because that's not necessary. The market can bottom whatever it wants. It doesn't have to be October. So therefore, that type of thing's not in this model. It's the things that must change if trend is indeed itself going to change. So I just wanted to give you that refresher and just underscore the fact that the simplicity of the model and the fact that it's just simply designed to capture inflections in these key drivers to trend, and they are starting to change for the first time throughout the course of this bear market. And remember, we had a couple of significant rallies throughout the course of the bear market, and those were 17 to 18% rallies, and they never caused these longer term indicators to uptick. So this is new, and it's important, and this is why we're leaning on the idea that the lows are in, and we can now bank on sideways to up. So if we look at the risk gauge again, we can see it here at the market level. A couple of observations looking at the sector level, so we can run the risk gauge across 4 timeframes by sector. Couple of important things to note. One is energy is still number 1, but we can see that it's weakened quite a bit in the short term. We're not thinking that that's the end of the energy trade. We're of the mind that this is still strong enough, and if you look at the long-term relative performance trend of energy, which I've featured a number of times in our chart packages, it's broken about a 10-year relative performance downtrend. So we think this is the beginning of a longer term move for energy. It's just pausing right here. So it's just less of an overweight for us right now, but it's still an overweight. This is super important. Industrials have moved into number 2 and pushed staples down to number 3, and utilities are now pushed down to number 5, being superseded by materials. So you can see, as you've been following this through the course of this bear market, we're starting to see more and more cyclicality work its way up into these top ranking sectors. So this is super important. It's key elements and key requirements, if you will, to a new bull market. And so we're starting to see it. So we're seeing the upticks from the risk gauge at the market level, and we're starting to see the relative performance leadership become more and more cyclical. So I want to point out that media and technology are still poorly ranked in their individual risk gauges, particularly media in real estate are still quite negative. And of course, this is technology. They're all 3 of them are sitting at 7. So it's not risk off. It's not catastrophic. In fact, they are improving, but they're still, you can see that they're a long way from being repaired, if you will. So where we would expect to see more hope for leadership from cyclical sectors, it would come from financials and consumer discretionary. So they're still not there yet. So our view is that you can find select ideas in financials and discretionary, but by and large, the big overweights are on the first page. This is an interesting way of looking at the markets, I think. So if you sort the sectors by their relative performance rank, which you see here, and this is just a weighted average of these different timeframes of momentum. So very short term, medium term, and long term goes out to 1 year. And just sort the table by that ranking, you can see that matches the risk gauges that I just showed you in terms of their order. But what we're looking at over here is the average change by sector since key tactical market swings. So we know the market peaked December 31st of 2021. And this is what each sector has done since then. So on average, the average stock is down 12.2% since the peak last year. And then the market bottomed the following February. This is what every sector has done on average, March, all the way out to the most recent December 1st peak. And the reason this is beneficial is because you can track from swing to swing how these these sectors are performing and what's driving their changes in relative performance. And when you look at energy, once again, we can see that in the very short term, it's actually ranked the worst. We can see why. Since the October bottom, it is up. It's up. The sector's up 2.9% on average, but that's roughly a third of what the average stock has done since the October bottom. And then since the December peak, the average energy stock is down 5.4%, which is worse than any other sector and nearly 3 times as bad as the broader market. So obviously we can see what's driving this decline in the relative performance for the sector. But we can also see that longer term structure is still very much intact. Can see it here in the ranking. So this is just, again, and I'll show you another chart in a moment as to why we think there's reason to take down your overweight in energy, certainly not as large as it was throughout the course of 2022. But look at industrials. It's outperformed on every swing, with the exception of since the peak. We can see as well, materials has actually been doing quite well since these various swings in the market. And then you look down here at the bottom, and you can see technology and media and real estate. They're just really been very poor, and then they're really kind of struggling to keep up. We're seeing some pockets of strength, but by and large, it's just not showing up there. So as we're watching the swings from one point to another, you can see the rotations within the leadership. In fact, you can see here materials since the August peak, the average material stock is actually up. So those are the kinds of things we're looking for. And the fact that the top of the ranking is getting more and more cyclical, and the cyclical areas of the market are leading swing to swing. This is just good. This is good, healthy, leadership from these various cyclical sectors. Something else we want to see, we don't see it yet, but it's certainly something we're going to want to see in time. Looking at the Dow theory, the whole premise is that the transport sector and the capital goods sector, they should move in the same direction as each other, thereby confirming their signal or their interpretation of the economy. So when they're moving upward at the same time, that implies a strong, healthy, robust economic environment. And when they begin to move lower together at the same time, there's warning that the market's interpretation of the economy is beginning to falter. So this process has typically done a very good job of adding insight as to what the market's interpretation is of the economy. And in particular, it's been very, very robust. And what we can see here is that capital goods have actually gone through the August peak. So remember, capital goods is a cyclical, very sort of high beta sector that's tied to the economy. And we can see that this capital goods sector is above its August peak already. So it's broken its downtrend, it's above its August peak, and the 200-day average is starting to turn up. That just doesn't smack of impending doom. It looks like the market's interpretation is getting better and better. So we can see capital goods starting to break out. That's a positive. From a Dow theory perspective, what we're now going to want to see is transports do the same thing. And we can clearly see at this point, we don't have that yet. The August peak is nowhere near being taken out. And in fact, the transports are still below their declining 200-day average. So again, we're early in the turning process. So this isn't bad news. In fact, if anything, at the margin, it's good news, because at least one of the sectors has begun to move in a manner that's becoming of a bull market. But now we need to see confirmation from transports, and we'll keep you posted on that in our weekly notes as time goes on. This is a really interesting way of looking at what's happening beneath the surface as well. And from what I can see here, again, we're early in the process, so we're not quite yet seeing the relative drivers that really say, okay, we're ready for a robust bull market. But at the margin, we see enough change to indicate that in time we will. So we'll just track it going forward from here. But I've introduced this before, but I'll quickly cover it again. I have a model called relative performance type, and it's basically a relative performance model, and it breaks down a stock's relative drivers, if you will. So you can track how well a stock does during bull and bear market environments, and you can basically dissect relative performance into those two components and get a sense for what's the purpose of this stock's what's the purpose of this stock? How does it best fit into a portfolio? Is this something you want to consider during bull markets, or is this something you want to consider during a bear market? So stocks that I refer to as strength stocks are stocks that have a history of being outperforming during bull markets and underperforming during bear markets. So these are the first stocks you want to go to when you're in a bull market. And then safety stocks are, of course, stocks that have a history of underperforming in bull markets and outperforming in bear markets. So when you're in a bear market, you would typically see these stocks outperforming. So let's take a look and see where we are today in that light. So if you look at all the stocks that have a relative buy rating on them in our relative performance signal model, you can see that 44% of the buys are in safety and only 24% in strength. So as it stands right now, this hasn't inflected yet. Again, we're early, but in time, we're going to want to see this change, because this will be confirmation that what we're seeing from the risk gauge is sort of spreading out and manifesting into a bull market in time. So right now, the spread is negative 20. And as you look down here, you see a lot of red. So it's just indicating that from a strength versus safety perspective, a lot of the relative outperformance still resides within safety. And in time, as this bull market unfolds, we're going to want to see this change. So here's an example here, relative moving averages. If you look at the 50-day average of the relative performance trend, 42% of the safety relative performance trends have a rising 50-day, and 40% of the strength stocks have a rising 50-day. So that's pretty close. It used to be a much bigger spread than it is today, but it's still negative. But again, it's getting close. This is the percentage of stocks that have a 50-day above the 200-day when you're looking at the relative performance trend, and you can see that 32%, I should say only 32% of the 50-day averages are above the 200-day average on the relative performance trend for strength stocks. So the majority of stocks are still in a downtrend from that perspective. 63% of the 50-day averages are above the 200-day average for safety. So clearly, strongly still tilting towards safety. So all of this needs to change, and we'll track it as we go forward. This is the percentage of stocks with a rising 200-day average on their relative performance trend, and 80% of the 200-day averages are rising for safety and only 22% for strength. So again, more work needs to be done. And then when you just look at breakouts, the net relative breakouts, say, for instance, over the past 13 weeks, there have been, there's a net negative spread in relative breakouts within strength. So it's negative, but it's nowhere near as negative as safety. So in the very short term, in the past 13 weeks, which is basically 3 months, where we are seeing a C-swell of relative performance breakdowns in safety. That's positive. That's a good sign. So therefore, this spread is now positive 16%. But as you trace out to the 1 year relative performance breakouts, you can see that this is still negative. So this is a very good sign. It's step one, and eventually, as time goes on, as we do these monthly videos and the weekly reports, we're gonna see these hopefully turn green as we move forward, indicating that the drivers beneath the surface are shifting towards strength, and more relative performance is shifting towards strength. So another way to look at it is just looking at some of these traditional relationships within the market. When you're looking within equities, consumer discretionary versus staples. When you're looking within factors, high beta versus low volatility. And then when you're looking external to the equity market, you're looking at copper versus gold. Clearly, you can see that all of these relationships, they tend to move in the same direction. And then in the same way, as these relationships are moving in the same direction together, they're also moving in the same direction as the market, which makes sense. So during a bear market, consumer discretionary just tends to underperform staples. In a bear market, high beta tends to underperform low volatility. And in a bear market, copper tends to underperform gold. So we're seeing all of that take place here. As it stands today, we have not seen these trends reverse yet. So as I said earlier, we like what we see at the margin. The risk gauges have turned up, implying to us that the October low is in. If that's true, we're going to start to see these relationships reverse their downtrends. And of course, we'll keep you posted as we move, but it is our expectation that indeed we will see that unfold as the year progresses. So this is that chart that I mentioned earlier. I featured it a number of times, but I think I need to keep it in front of you just to keep it front and center, because I think it's important as it relates to the energy sector. So this black line here is the price of crude oil, and that's the scale over here on the right. The gold line is crude oil versus S&P, so the relative performance of crude relative to the S&P, and then the blue line is the energy sector relative to the S&P. And what you can see here is that when oil is working and in particular, oil is outperforming the market, that's when you tend to see your most robust outperformance from the energy sector relative. And so what we're seeing here that has me a bit concerned about the near-term performance for energy sector is this collapse in oil and the corresponding collapse in oil versus the market. Again, typically you would see the relative performance of the energy sector turn down as well in sympathy with these two, what effectively are the relative drivers of that relationship. And yet we don't see that. There's this massive jaws that's opened up here between these two relationships. And it is my thinking that in time, this jaws will close. If all goes well and the bull market is indeed taking shape, the way we'll see it close is that oil will stabilize and begin to move higher. And this relationship will therefore turn higher as well. And in the end, we'll have seen this to be we'll interpret this to mean that the market was looking past this correction in crude and was thinking that this is just a temporary setback and energy is still leadership. And so that's our current interpretation. But this is enough of a gap in this relationship that we want to take our overweight in energy down. Still overweight though. So then we're looking at consumer discretionary. Again, I showed you earlier that in the risk gauge for consumer discretionary, there's some things to like about it, but by and large, it's pretty poorly ranked longer term. And you can see that here from a cap weighted perspective. This uptrend that began at the global financial crisis lows has broken, and this is a massive multi-year top. And you can see that the trend line that's underpinning that trend from an absolute perspective is also coming under some pressure here. So from our perspective, from the bottom up, vis-a-vis the risk gauges, and from what we see here, we're underweight consumer discretionary. There are places you can find within consumer, but by and large, it's an underweight. But I want to show you this as well, because this is looking at the sector equally weighted. So if you look at equal weighted versus cap weighted within the consumer discretionary space, you can see that this trend has been broken, and it's actually cycled through to new highs beyond the 2021 peak. So this tells us that as bad as this chart looks, it's not as bad as it may seem when you dig beneath the surface. There are some ideas, pockets of strength, pockets of attractive relative performance that you can find within consumer discretionary, but by and large, thinking about it at the sector level and whether you're overweight or underweight, I think at this point, it's still safe to say that you can be underweight. And I think this next chart also corroborates that idea as well. So this is consumer discretionary equally weighted versus the S&P equally weighted. So it's not nearly as bad, more recently anyways, it's not nearly as bad as what you're seeing here in terms of relative deterioration, where you're seeing it bouncing here in this risk gauge. Our risk gauges are picking up on this, but it's still, there's nothing here to really say to us that you really need to be overweight consumer discretionary at the sector level. Okay, let's talk about growth. I've been highlighting this chart for a while, but I think we need to keep this in mind as this potential bull market begins, because I think what you could easily see is that the bull market gets underway and growth continues to lag. And I'll explain that through a series of charts here. But let's start with this one. At the last peak of the last growth bubble, the dot-com peak, you can see that growth underperformed value for 7.5 years. Now, that's a long time. It's happened before, and I would make the case that it will certainly happen again, and perhaps that is what we're seeing now. But the more important point to make is that this leg of underperformance of growth versus value, don't forget that this happened during a bull market. It's just that growth was not the leadership. Energy was. Home builders, materials, remember the China trade. That was a very robust bull market from 2002 to 2008. And throughout that whole thing, growth underperformed. So my point here is that we don't need growth to outperform in order for there to be a bull market. So this is similar to the discretionary chart. You can see how the NASDAQ 100 has also been in an uptrend since the 2009 bottom. But of course, most of the market has been. But you can see how we are really pressuring this uptrend. And if this gives way, that's just one more sort of nail in the coffin for the growth trade, for tech and things like that, at least for now. It doesn't mean forever, but it just means, what you see is what you get, and what you see is not good. So let's just go with that until it changes. How might this break its uptrend? Well, this is the price of Apple. This is the chart of Apple. And this looks like, at best, it's a sideways condition, possibly rolling over into a downtrend. We'll see if that's indeed what takes effect. The 200-day moving average is rolling over, but the relative performance is something that will matter quite a bit going forward, because this doesn't have to break down. The chart doesn't have to break down, but if all it does is kind of go sideways as it digests this preceding, bubble / bull market in technology, this line could easily underperform. And if indeed this does break through that 130 level, then you could easily see the NASDAQ 100 break through this uptrend. And that wouldn't be ideal for the bull market scenario. Broadly speaking, you generally don't want to see such a large index break its trend, but we need to be open-minded to the possibility that this was such. I mean, look at this deviation from trend. I mean, this was such a incredible bubble that it's very likely that it's going to be a while before this is ready for prime time and ready to lead again. And these mega cap names are very well what could keep this index from leading again. And while that's all unfolding, we're seeing better places to put our money: energy, industrials, materials, some financials, discretionary, et cetera. This chart is interesting. This is outside of my wheelhouse, but AQR recently published this note, and it's just a valuation spread according to their models, and it just shows you how rich the growth trade is still, despite the recent correction we've had, and how much further this can go to the downside. And I just want to point out that the last time it was up here this far was that last bubble in 2000, and it took all this time to completely reset itself. And again, I want to stress that during a good part of this unwind, that was actually a bull market. So keeping an open mind to the idea of how this reset within growth might unfold despite an ongoing bull market. There's a couple of things to think about as to what might be driving this transition away from growth and tech and whatnot. We've been hearing a lot about all these layoffs taking place in Silicon Valley and these big mega cap companies: Amazon, Meta, Google, Apple. So look at what we all know this, but this is their employment trends over the past couple of years, and now they're starting to lay off people. And again, I just is layoffs a sign of robust underpinning growth in demand for products? And I think it would make sense to me that no, it's not. So this is not this is certainly not something where we have characteristically seen of these mega cap growth names over the past 10 years. They've been hiring more often than laying off. So maybe this is just a sea change that's taking place temporarily within that space. And it's worth noting that Microsoft just recently, the employees at Microsoft just started their first employee labor union. So that, again, that sounds more like a railroad or a utility or some industrial company, not these really high growth, hyper growth names out in Silicon Valley. But this is what's happening in that space. So all this just looks different from what we've seen over the past 10 years. And who knows, maybe this is what drives the underperformance, in addition to the fact that there was such a valuation expansion, et cetera. One more thing to think about in terms of growth: if you take the Russell 1000 growth, the ETF, and you just look at what's in that ETF, not surprisingly, you'll find that 43% is technology, 14% discretionary, 13% healthcare, and then industrials. So I think that this allocation across the sectors would not surprise a lot of people. But if instead, and so therefore you can also see why growth is doing so poorly versus value, because it's so overweight technology, and technology has been so poor. But one of the things I do in my research process is I bucket the market by revenue growth buckets. So these two up here are any stock that has top line revenue growth in excess of 50%. So it's 50.1 if the company's profitable. It's 50.0 if the company's not profitable. So the benefit of doing this kind of thing is then you can now look across each line and just treat it as if it's its own portfolio. And this will all add up to 100%. And you can see that the biggest weight in this profitable, rapid revenue growth bucket is energy. And it's only 6% in technology. And then when you go down to the next bucket of 35%, so this is revenue growth of 35 to 50%, the biggest constituent in that bucket or in that portfolio, if you will, is energy once again. And where you find a lot of technology, it's in the unprofitable growth. And of course, you find a lot of unprofitable, you find a lot of healthcare in the unprofitable rapid growth as well, which of course is the biotech space. But I think it would surprise a lot of people to see that if you actually map a portfolio today to where the actual growth actually is, not where it's been, but where it is, you'd find yourself with a portfolio that's very overweight energy. And I think that's when you think about philosophically about what drives price higher over time, one of the factors that's most important to that outcome is top line revenue growth. The more rapid the top line revenue growth, the better the stock price performance. And if you think about what happened from 2002 to 2007 and 8, where growth underperformed, the best growth actually was in energy, materials, home builders, and things like that. So actual growth, where the actual growth, where the rubber meets the road, where was the actual growth, top line growth taking place? It was in the sectors that outperformed from 2002 to 2007 and 8, not in all the stocks and sectors that were in the growth ETFs. So I think this is important. So it's not that growth won't matter for the next, for this, impending bull cycle. In fact, I think it's going to be all that matters. But you may find the growth to be in places that might surprise you, and that certainly not finding it in places where it was, but instead finding it in places where it is. So quick note on sentiment. Again, talking about that, the setup sentiment is a big part of bull market or bear market bottoms. When you're looking for the setup of a bear market bottom, extreme bearish sentiment is typically a contrarian signal indicating that the lows should be in. The problem is, and again, this is the risk of just acting on setups before you have a catalyst, is that we know that this bearish sentiment, which as you can see is as bearish as it's ever been in this survey, all the way back to the late 1980s. It's been bearish for a very long time. It's been all throughout 2022. So if you acted on this survey just because of the bearishness, expecting a bear market bottom, obviously you would have been very early and very wrong. And so the point, though, is that now that the market is inflecting, indicating that it does care about this stuff, knowing that this is the backdrop and that the sentiment was this bearish, we actually now have a rather large, well-fortified, well-built wall of worry for the market to now climb, and it shows up clearly in sentiment. Another place it's showing up is in earnings estimates. We can see that earnings estimates have actually gone negative for the upcoming quarter. So the bar for companies in the next quarter is actually quite low. So with a very low bar for earnings in a market that's inflecting higher in the monthly and quarterly timeframes, which again I want to stress is the fundamentally driven timeframe. These trends are driven by fundamentals. They're inflecting positively. And they're inflecting positively at a time when the bar to step over in terms of earnings expectations is quite low. Another sentiment gauge that I think is really important, of course, another one of those gauges that got extremely bearish early on in the 2022 bear market, and so therefore, if you acted upon it at that time, you would have been very early and very wrong. But this is the University of Michigan consumer sentiment, and you can see when it gets really low and then inflects higher, it's happened at major cyclical bear market bottoms. And so this is the setup. The setup is there. It's been there for a while, but now that the market's inflecting, I think this sentiment reading matters now finally. And another one that really is intriguing to me is the put call ratio. So if you take the 10-day moving average of the put call ratio, that dark blue line, it's higher than it's ever been. In fact, the 10-day moving average is higher than almost just the pure readings. So this is how extreme the bearishness has gotten in the market. And this, what's really perverse about this is that this record reading is following what was a record reading in the other direction. So we're seeing a lot of really strange activity taking place in the options market. But as it stands right now, it's at a record. The actual raw date is way up here. It's not even, I mean, it's like nothing's even close to this reading in its history. So this is a extreme bearish reading. And now that the market's inflecting, it's quite possible that it matters now finally. And given that it's so extreme here, and here, I think we have a nice wall of worry for the market to climb. So as a consequence of the potential that growth is going to underperform and that tech is underperforming and will continue to underperform, we need to be mindful of the possibility that that results in a break of this, again, trend that's been in existence since the global financial crisis bottom. This is the U.S. versus the world. As much as we'd like to think the U.S. is a wonderful place and that's why it's outperformed during this period, the reality is it's outperformed during the past, 10 plus years, because this is the best technology ecosystem on the planet. And so because it's such a good, robust technology sector here, this is why we outperform. And doesn't it stand to reason that if indeed that technology sector is going to take a breather for a period, that the U.S. versus the world ex-U.S. Uptrend will finally come under pressure this year? And I think that's something we need to be mindful of. In fact, we're already seeing it. If you look at the ranking of the various country ETFs, the U.S. is down at the bottom. So it's already taking place. So now it's just a matter of, what's driving it. How much of it is actual fundamentals, how much of it is currency and things like that. So when you look at the, just by way of example, look at Europe, keep in mind this is the August peak. So the U.S. market is nowhere near this peak. It has not broken through this peak yet. This is Europe. It's through the peak. So it's broken this downtrend, which the U.S. has not done yet. It's gone through this peak. The 50-day average has crossed the 200-day average. So in the checklist of trend change, the only thing that's left is for the 200-day average to move up, to turn up, thereby confirming the trend that's already underway. This is by definition a series of higher highs is an uptrend. So this is Europe. Europe has been an underperforming market for probably 20 years in aggregate over time. Of course, there's been bouts of outperformance, but by and large, it's been in a void. Mostly because it has no tech sector. It's industrials, banks, energy, and things like that. So it's very conceivable that we need to be mindful of the idea that Europe and Asia and other parts of emerging markets are where we need to look for leadership in the coming year. As I said, the dollar is going to play a big role in this. I'm not yet in the camp that the dollar trend is down. We did write a note, call it luck if you will, but we did write a note up here calling for a setback in the dollar just because you're at the top of the channel and the rolling 12-month rate of change reached the level at which it typically pauses. And so what we can expect from here is just a retest of the former highs from the preceding range. And so we've already done that. I mean, yes, we did get a setback, and admittedly, this happened way faster than I would have expected. Perhaps because it happened so quickly, maybe that is an indication that the whole uptrend is over. We'll see. But right here is not a great place to make the bet that the dollar trend is down. I think, again, if you think about sideways, up or down, and you're trying to eliminate one of those situations, I think up is conceivable for now. But because we're sitting right on support, I'm also not too married to the idea of the market of the dollar going lower. That leaves me with sideways. So I don't really think it's going to be much of a factor for the near term here. But so we'll continue to watch it as the year unfolds. But it'll obviously play a big role as to whether or not this trend is ultimately reversed for fundamental reasons or for currency reasons. Lastly, I want to point out that the 10-year Treasury yield also has been and will continue to play a key role, in particular the relationship between growth and value, because this obviously compresses valuations. One of the charts I featured in the first note of the year, which was about 27 charts to monitor for the coming year, it was basically the 10-year Treasury yield overlaid with the earnings yield on the S&P, and it's basically the same chart. So if this chart goes up, if this trend goes higher, you should anticipate that the earnings yield will go higher on the stock market, which can happen because the market goes down, or the market goes sideways, or maybe even goes up a little bit, but earnings go up a lot, and so therefore driving the earnings yield higher. So in any case, it's if the earnings yield is going higher, it's definitely going to be a headwind for the broad market, not necessarily for individual stock selection. I would imagine that a strong move higher and continued strong move higher in rates as a result of inflation and different dynamics causing rotations within the different equity factors. You could see just this continued push towards energy, materials, industrials, which we're already seeing. We're already seeing it, and it could just be that we just continue in that direction. and moving away from growth-oriented sectors. But as long as rates are above the 2.5 to 3% range, which you can see here in this green box, I just think that the earnings yield on the market is at risk of being pressured higher one way or another. So we want to keep an eye on this as the year progresses as well. Just looking for individual ideas. If you look at the top ranked industries, you can see that here. These are the top 20 industries. Here's some ideas within that space, within these industries, and then these are the worst ranked industries. And again, you can see a lot of tech, a lot of consumer, media is still in there, internet content. So these are all stocks that have really participated on the downside. If indeed we are in the middle of putting in a low, you might very well see a lot of these stocks do rather well in the short term, but in time, I think this is where you want to go back to in terms of your short exposure. If you're looking to continue to maintain short exposure throughout what I believe will be a bull market. So if you're biased towards having short exposure, even though you're in a bull market, I think this might be a good place to search for short ideas after they've completed their sort of dead cat bounce, if you will. Okay, so let's summarize. I think the odds are that the lows were set back in October. I would recommend that you don't get too caught up in the notion of whether or not this is secular or cyclical. That's not relevant, because all we ever are trying to capture, whether it's secular or not, is we're trying to capture cyclical trends. These cyclical trends can last for months, maybe years. That'd be great if it did. But we don't have the answer to that question. And we will never know the answer to that question without hindsight. So if you start asking yourself questions you can't answer, you won't take action because you can't answer the question. So rather than ask the question, is this a secular bull market, because I'm not going to buy it unless it is, that's going to impede you from participating in this cyclical bull market. So I would just accept the idea that we have enough evidence on the table now to warrant expectations for a cyclical bull market, and that's good enough. That's all we need to really favor cyclicality and favor taking a bit more risk in the market than what we've been taking over the past year. And we'll just take it day by day and week by week, and we'll continue to update you in the course of the through the course of the year in our weekly notes and these monthly videos. And just at the margin right now, it looks to me like we have enough evidence to support the idea that it's a cyclical bull market, and that's all we need to know. One thing to be mindful of as we go forward is that if this all plays out, we're likely in the next couple months, we're likely to see a very extreme overbought condition. And you're in that moment, you'll probably hear people come out of the woodwork saying, this is the most overbought we've been in this entire bear market, so therefore it's the best sell signal. This is the best time to get short. And I would encourage you to actually think about it the other way. When you get the most extreme overbought condition that you've had throughout the course of a bear market, that's typically a buy signal, not a sell signal. Because if you're in a bear market, you don't typically get that overbought. So if we get really overbought, particularly if it's the most overbought we've been in a year, think about that as being a buy signal, not a sell signal. I showed you a lot of charts today. As I showed you, there's a lot of things that still need to come into alignment for a bull market. So because of that, I'm not saying let's get fully invested at this point. I'm not fully invested. I do have my largest gross long exposure on that I've had in a year. I'm continuing to favor what I've been favoring for the past year in terms of leadership, owning energy, materials, and industrials, and select discretionary finance, and yes, even some technology. There are some, although technology and growth in general is likely to be an underweight for a while, there are some select technology ideas, as there always will be, even if the sector is not doing well. And then as it relates to shorts, what I'm doing is because the models have inflected, I won't be adding to any short exposure into this overbought condition. As I said, if it gets very overbought, it's actually bullish, not bearish, and so that's even a worse overbought condition to sell short into. So what I'm doing is I'm just maintaining a smaller short position, and if I begin to get stopped out of individual names, then so be it. But if the risk gauges tick up again and get into the fives, thereby getting into the top half of the risk gauges, I will automatically cover all short exposure. So that's just how I manage money. I don't short during a bull market, so this is the systematic process by which I cover all my shorts. Is when the risk gauges tick up into the fives, then I just cover all my shorts. I will put them back on again if the risk gauges, if this ends up being a false signal and the risk gauges begin down ticking again. We take out 3,800 to 3,900 support. That would be reason for me to weigh in again with short exposure. But for now, that's how I'm going to exit my short exposure. As it relates to finding ideas for those that still continue to get short, even though it's a bull market. Of course, I'll continue to update and share short ideas in the service. I just won't be doing them myself. So that's what I have for you. I hope you found this helpful. There's a lot of information here. If you want to walk through these slides with me over the phone, give me a call. Happy to do that. Happy to walk through some ideas and just kind of walk through how the risk gauges work. Whatever you need, just give me a call, reach out, and shoot me an email, and we can certainly set up a Zoom, and I'd be happy to walk through this with you. So that's it. Happy New Year. Thanks for listening, and looking forward to chatting soon.